is how can we automate options trading. So options, like any other strategy, the process is the same, but only thing which you should keep in mind before automating is you have to follow the same set of process. So the first step is you should get the data. So option data is slightly different compared to rest of the data set, because here you have different strike price. You have call and put, which are the two kind of options which are available. For each of this call and put, there is a different strike price, and there is open interest along with volume, which you have to track. And generally, options are not all the options, all the strike price are not very heavily traded. So therefore, you should also look at the bid price and ask price for each of this option. So you need to collect all this data when it comes to option. And along with this, you will need the underlying asset price, so that you can calculate various things from it, like how far the strike price is, whether the strike price is in the money, out of the money, and what is you also have to calculate what is implied volatility to create a good strategy. So this is all goes into the data part. Once you have the data, the next step is you have some kind of a trading strategy in mind. Let's say you want to trade where you want to capitalize on high volatility. When the asset price is having a high volatility, you want to capitalize on that. So typically for that, you can select strategies like straddle and strangle. So straddle is when you sell at the money call and at the money put. So this is at the money call and this is at the money put. So this is how the straddle look like. If you're slightly risk averse, you can go for a strangle. So for strangle, you just go for out of the money put. You sell out of the money put and you sell out of the money call. So these two are widely used strategies when your view is you want to earn from theta, and you also want to capitalize on high volatility and pocket premium from it. So just to repeat again, step number one is to get the suitable data. Step number two is to identify the strategy which you want to automate. So here, let's say we finalize, like we want to go ahead with straddle. So let me give a green tick mark to this. Then the third step is to actually backtest this hypothesis, systematic trading. So on what occasions will you go and sell the straddle? That needs to be defined by you. Let's say you define rules like IV has to be IV percentile. Let's say IV percentile is nothing but you take implied volatility, you calculate implied volatility for say let's say last 200 days. You sort that and you calculate the IV for today. Let's say IV for today is 35, and you calculate IV for last 200 days, and within last 200 days you find that this 35 is at if you sort in ascending order from lowest to highest, this IV 35 is at the position 180. So there are 20 implied volatilities which are greater than 35, and there are 179 occasions where implied volatility was less than 35. So how do we get the implied volatility percentile? Simply you say that the implied volatility percentile is 90. So which means that 10% of time the volatility was more, and rest 90% of time the volatility was less. So one of the entry conditions while setting up straddle could be the IVP has to be let's say greater than 80%. Let's say the first condition can be that. So I will only sell straddle when my IVP is greater than 80. Okay. So typically I can collect higher premium when the implied volatility levels are higher. Let's say it is at the 80% zone. So if I take the historical data, I haven't seen such IV. Such IVs were only seen 20% of time, which is in last around 40 days. Such IV was seen. For remaining 160 days, such IV was not seen. So those are the conducive conditions or conducive areas to short the straddle.